2008, the year the American economy nearly collapsed, and if you lived through it, you remember two completely different realities happening simultaneously. On Main Street, families were losing their homes to foreclosure at rates not seen since the Great Depression, with 9 million Americans eventually evicted from houses they'd spent decades working to pay off. Unemployment spiked to 10%, meaning 1 in 10 workers couldn't find a job no matter how hard they tried. Retirement accounts that people had spent their entire careers building vanished as the stock market dropped 53% in 18 months, and entire neighborhoods turned into ghost towns with rows of foreclosed houses sitting empty with broken windows and overgrown lawns, while the families who used to live there were sleeping in motels or cars or with relatives, their lives completely destroyed by a crisis they didn't create and didn't understand. But on Wall Street in those same months, when ordinary Americans were losing everything, something very different was happening. Despite posting the worst losses in their history, despite requiring massive government bailouts funded by taxpayers, despite being directly responsible for creating the crisis through reckless lending and fraud, Wall Street banks paid out $18.4 billion in bonuses in 2008, making it the 6th largest bonus pool on record. And while that sounds insane until you understand how Wall Street actually works, where bonuses are rewards for performance, but compensation structures designed to extract maximum wealth, regardless of whether the company makes or loses money, meaning executives and traders got paid massive bonuses even as their institutions collapsed and required taxpayer rescue. And if you think those bonuses represented some temporary embarrassment that Wall Street quickly corrected, you'd be wrong, because by 2009 bonuses rose sharply again. By 2010, Wall Street paid out a record $144 billion in total compensation, and by 2014 cash bonuses hit their highest levels since the 2008 crash, all while Main Street was still suffering through a slow, painful recovery where wages stagnated, good jobs disappeared, and millions of people never recovered the wealth they lost. Think about what this means. The people who caused the crisis, who engaged in predatory lending that they knew would destroy families, who packaged toxic mortgages into securities they knew were garbage, but sold as AA-rated safe investments, who crashed the entire economy requiring trillion-dollar bailouts. Those people not only kept their jobs, not only avoided prison, but got paid billions in bonuses using money that came directly or indirectly from taxpayers. But the story gets worse, because Wall Street didn't just survive the crisis they created. They actively profited from the destruction by buying up the wreckage at bargain prices and turning ordinary people as misery into investment opportunities that generated billions in returns. Enter Blackstone Group, the private equity giant, which between 2012 and 2016 spent more than $10 billion buying approximately 48,000 foreclosed single-family homes across America, purchasing them at rock-bottom prices after the housing market collapsed, after families had been evicted, after neighborhoods had been devastated, essentially swooping in to profit from the crisis their industry had created. And this wasn't some charitable effort to stabilize housing. Blackstone bought these homes to rent them out at rates higher than the original mortgage payments would have been, trapping former homeowners and other families in a permanent renter class while extracting wealth through rent payments that never build equity. When Blackstone took its rental subsidiary Invitation Homes public in 2017, it generated $7 billion in profits, meaning they made $7 billion by buying homes that families lost to foreclosure during a crisis Wall Street caused. And Blackstone wasn't alone, and total hedge funds and private equity firms bought approximately 200,000 foreclosed homes in the years following the crisis, transforming housing from something ordinary people could own into a financial asset that Wall Street controls and rents back to the same people who used to own homes before the crisis destroyed them. So let us be clear about what happened. Wall Street created a crisis through fraud and reckless gambling, got bailed out by taxpayers when their bets went bad, paid themselves billions in bonuses during the worst economic collapse in generations, then bought up the homes that families lost to foreclosure at bargain prices, and turned those homes into rental properties that generate ongoing profits by extracting wealth from the same people they destroyed, creating a perfect closed loop where Wall Street profits at every stage, before the crisis, during the crisis, and after the crisis, while ordinary people lose at every stage. Fast forward to 2020, And you might think Wall Street would have learned something, that after the devastation of 2008, there would be reforms or consequences, or at least some shame. But instead, when the COVID pandemic created another economic crisis, Wall Street repeated the exact same pattern of profiting from disaster while Main Street suffered. In the second quarter of 2020, when unemployment spiked, when small businesses were closing permanently, when families were struggling to pay rent and buy food, Goldman Sachs reported its best quarterly performance in a decade, with a 17.5% return on equity, its highest since 2010, driven by a 29% surge in trading revenues as market volatility created profit opportunities. The firm's earnings per share beat analyst forecasts by a wide margin, prompting executives to celebrate their record results while millions of Americans were filing for unemployment. J.P. Morgan Chase showed similar results, posting an $11.9 billion profit in the second quarter of 2021, up from $4.7 billion the year before, with trading revenues soaring as market chaos created opportunities for banks with the capital and infrastructure to exploit volatility that destroyed ordinary investors. And this wasn't a one-quarter fluke. Through 2021, major Wall Street banks reported some of their best earnings in years, with Goldman Sachs returning to the kind of profit levels it hadn't seen since before 2008, all while Main Street small businesses were closing at record rates and families were facing eviction as pandemic protections expired. The pattern is unmistakable and has repeated through every major crisis. Wall Street profits from disaster while Main Street pays the cost. And this isn't an accident or a coincidence, but the deliberate result of how the financial system is structured to transfer wealth upward during times of crisis. Here's how the mechanism actually works, and once you understand it, you'll see it everywhere. During normal economic times, Wall Street makes money through traditional banking and investing. But during crises, when asset prices crash and ordinary people panic and sell everything, Wall Street institutions with access to cheap capital from the Federal Reserve and government support can buy assets at rock-bottom prices, wait for the inevitable recovery that government stimulus and bailouts ensure will happen, then sell those assets at massive profits or hold them to generate ongoing income streams. It is a system designed around the principle of privatize the gains, socialize the losses. Meaning when Wall Street East bets pay off, they keep all the profits, but when their bets go bad, the government steps in with taxpayer money to prevent collapse, ensuring that Wall Street never actually faces the consequences of their risk-taking, while ordinary people who had no say in those decisions bear all the downside. And because Wall Street knows they'll be bailed out if things go wrong, they have every incentive to take massive risks that generate huge short-term profits and bonuses, because if the bets pay off, they get rich, and if the bets blow up the system, taxpayers absorb the losses while Wall Street executives still get paid. The 2008 crisis proved this beyond doubt. Banks engaged in predatory lending they knew would fail package those bad loans into securities they knew were toxic, sold those securities to investors while betting against them, crashed the entire economy, got bailed out with trillions in taxpayer money, paid themselves billions in bonuses, then bought up foreclosed properties to profit from the destruction they caused. And not a single senior executive went to prison or faced any meaningful consequence. The 2020 pandemic proved the pattern continues. While small businesses closed and families struggled, Wall Street posted record trading profits by exploiting the market volatility that COVID created, and once again faced no consequences for profiting from crisis. This is the fundamental design of the modern financial system. Wall Street exists in a protected class where they can take unlimited risks, knowing they'll be rescued if those risks blow up, where they can profit from creating disasters, where they can extract wealth from ordinary people during good times through fees, and during bad times by buying assets at distressed prices, where crisis isn't a threat but an opportunity, and where the worse things get for Main Street, the more money there is to be made on Wall Street. And the reason this keeps happening, the reason nothing fundamental changed after 2008, the reason Wall Street profited from COVID the same way they profited from the housing crash, is because the people who would need to reform the system are the same people who benefit from how it works. Politicians who receive campaign donations from Wall Street, regulators who came from Wall Street and will return to Wall Street after their government, service economists who consult for Wall Street while teaching at universities, Media outlets that depend on financial industry advertising, all creating a web of incentives that ensures no real reform ever happens, because everyone with power benefits from the current arrangement. So when you wonder why Wall Street never faces consequences, why executives who commit fraud get bonuses instead of prison time, why banks that crash the economy get bailouts instead of bankruptcy, why hedge funds that buy foreclosed homes get celebrated as savvy investors instead of condemned as vultures, why Goldman Sachs can post record profits during a pandemic while small businesses close. The answer is that the system isn't broken. It's working exactly as designed. And it is designed to transfer wealth from people who work for money to people who make money work, from Main Street to Wall Street, from the bottom to the top, using crisis as the mechanism for the most aggressive wealth extraction. You lost your home in 2008 while Wall Street got bonuses. Not despite the crisis, but because of it. Not in spite of the bailouts, but through them. Not accidentally, but by design. You struggled through COVID while Goldman Sachs posted record profits. Not because they re-smarter, but because they repositioned at the extraction point where crisis creates the opportunities that destroy you and enrich them. And the next crisis, whenever it comes, will follow the same pattern, unless you understand that Wall Street and Main Street aren't two parts of the same economy. They two different economies with opposite interests, where your loss is their gain, where your crisis is their opportunity, where the game is rigged so completely that winning isn't even possible for you, only for them.